Good morning, everybody, and welcome to our first webinar of 2018. The end of 2017 proved to be quite eventful. Not only did we get the outcome of the ANC elective conference, but we also experienced the turmoil in the markets with regards to the failure of Steinhoff and corporate governance concerns around that, and what has transpired since with regards to several other counters in the market, and questions around corporate governance within the private sector in South Africa. So we have a few slides we'd like to talk to with regards to what we saw in 2017 and what we see going forward. We'll spend about 40 minutes talking, and then we will take questions at the end of the webinar. I'm Claire Ensker, the Chief Investment Officer at 274 Investment Managers, and joining me this morning is also Nadir Token.
Morning, everybody.
So if we look at 2017, it really was within the equity markets a story of a few counters. Despite having fairly strong performance from the equity market overall, it was driven by a few counters in particular. So there was very little breadth to the equity market through the year, and what this meant was a fairly difficult environment for those managers who see themselves as stock pickers. So it was fewer than 1 in 4 stocks that managed to beat the index return of 21% for 2017, and within that, there were slightly over half the stocks that ended the year in positive territory. So a very wide dispersion within the market, and actually very little breadth to what drove performance. Sorry, it appears that we are having some technical difficulties today, but let's try just pick up where we left off. So what we saw, even though we had NASPERS driving the market so strongly, it actually wasn't the best performing stock in 2017. So if we look at some of the other stocks that did exceptionally well, we can see that if you take a stock like Kumba Iron Ore, it returned almost 140% for the year. But because it had such a small weighting in the overall index, that 140% only really contributed 20 basis points to the overall index return. So definitely a market that was driven predominantly by NASPERS and the performance there. But there were other stocks that delivered stellar returns, particularly some of the resources stocks that did very well off the back of increasing and renewed global growth. However, their position sizing in the index meant that their overall contribution ended up being fairly small, whereas NASPERS doing over 70% at almost 21% of the index contributed almost 12% to the index's return. And it was very difficult to beat that return. So if we look at how NASPERS performed, and if you'd built your portfolio having only NASPERS and then invested the rest of the index weights into a cash portfolio, it really, you would have delivered a return that you could have generated through having if you're known with perfect foresight which stocks were going to perform the best, you could have had a return from those other 39 outperforming stocks that gave you an equal return to just holding NASPERS and cash. So what it meant for the year was that any research effort really went into the holding of NASPERS and how much you needed to hold, even if you'd known perfectly which shares were going to outperform the index in 2017. It would have been incredibly difficult to replicate what you saw from just the NASPERS return on its own. So what it meant was that the incentive for managers to do lots of fundamental research on the market and to unpack the drivers of return in the broad market was really unrewarded. What was rewarded mostly was knowing how much to hold in the single counter, which was so large in the index, and then really the rest of the portfolio could have been parked in cash. Even knowing which shares were going to outperform, you would have struggled to deliver the same kind of performance. But there are perils in such a concentrated market as well. So what we saw towards the latter half of 2017, so in November and through to the end of the year, was there were concerns around NASPERS and corporate governance, particularly within the multi-choice stable, and we saw a 15% decline peak to trough of the NASPERS share price. So that 15% decline would have actually lost investors more money than the failure that we saw within Steinhoff. Now, many managers who maybe didn't feel convicted to hold NASPERS at the full benchmark weighting would have potentially upweighted Steinhoff as another natural rand hedge in their portfolios, and the combined loss from both the decline in the NASPERS share price and the failure of Steinhoff would have led to permanent losses of capital in investors' portfolios. So the peril of being concentrated in a specific segment of the market and having large positions in a few counters is not without its risks. So really, it brings back to the front of our mind the fact that managers need to be risk managing their portfolios very closely. They need to understand what it means to have a position of that size in the portfolio in terms of the potential losses that it can bring through into investors' portfolios. But moving on to 2018, we've seen that having the result of the ANC elective conference come out in a way that's favorable for business has buoyed the market in terms of investor confidence, and in addition, we hope business confidence turns around. So we've seen that business confidence has begun to improve, and what that means is as businesses feel more confident, they're better able to make investment decisions around investing into the South African economy, to generate returns and to generate economic growth ultimately at the end of the day. So what we could see is that now that a lot of the uncertainty has been removed, global growth increasing, businesses start to feel more confident, and that could provide support for the equity market going forward into 2018. So emerging markets in 2017 were definitely favored in terms of the money that circled the globe searching for yield. Emerging markets were definite beneficiaries of large inflows. However, South Africa was a laggard in terms of those foreign flows. So the high amounts of political uncertainty, the low economic growth meant that investors shied away from allocating to South Africa, and the country didn't see the same level of foreign inflows that other emerging markets did. So hopefully with more certainty and a brighter outlook into 2018, we can have a reversal and participate in those foreign flows. And what's been seen to date is that those flows have actually come through very strongly. We've seen some of the highest inflows that we've seen in the country since 1998. And as that money flows in, it's positive for keeping our market buoyed and providing positive market momentum. What is going to be very dependent on those flows is how the bond market reacts. So in terms of the rating and how South Africa stacks up to other emerging market peers, even though we've had the downgrades and we've seen a less favorable outlook from the rating agencies, and South Africa is definitely not out of the woods in terms of meeting all of the requirements that the rating agencies had for stabilizing their outlook on South Africa. Our bond market yields have been fairly valued relative to the other peers. So despite the maybe a cautious fiscal outlook and a budget deficit that we've seen widening, that's going to need to be plugged and fiscal restraint put in place to try and alleviate that. Our bond market has still offered foreign investors a return that they have felt has compensated for the risk, and where bond markets are sitting at the moment, they're still fairly priced, and the yield differential there is going to be dependent on those foreign flows. Of course, funding does remain a major concern. So we saw numbers coming out from Eskom in terms of their financial position and the fact that looks incredibly dire. As much as Minister Gigaba can say that Eskom will not be receiving any more money, the reality is that they do need more funding to continue going as an entity and to continue even operating. It's going to require more funding from the fiscus. So even though there've been very positive turnaround and a purge of the board and a look to clamping down on the governance structures and rooting out corruption within state-owned entities. The reality is that in order for them to keep going, they are going to require more money. So funding risk is a major concern and will be at the forefront of the minds of the rating agencies as they review our position and our debt and funding requirements. So we've seen into 2017 how that's escalated rapidly. The reality is that 2018 is not going to be an instant turnaround, that there's still a lot more money that has to flow to keep these entities going until they can have improving operational structures put in place and begin to function and operate in a more efficient manner and provide the services that they're supposed to provide in the most efficient, cost-effective way. So funding is definitely a concern, and given how strongly bond yields re-rated post December, it's with caution that we look at the bond market, and our investment managers also position their portfolios in terms of duration coming into February and the budget speech. The reality is that there is reason to still be cautious, and we need to monitor those bond yields closely, because the funding risks could result in a spike in those yields. But global growth is picking up, and we've seen the cycle improving around the globe, and that will be positive for South Africa. You know, as a small economy, we are governed by what happens in the rest of the world. So anything that happens there will impact what happens within our borders as well. And we've seen that in the forecasts for 2018, that global growth is definitely trending upwards. So what this graph shows is just the difference between the forecasts that were made for growth in 2018 in January of last year versus the forecasts in December of last year, and we can see that the picture is definitely positive, and the growth cycle continues to improve across the globe, which will be positive for South Africa as well. And with that comes improving commodity prices. So we have seen that commodity prices have recovered. We've seen a recovery in demand for commodities, and that is not necessarily all predicated on China and what might happen in China. We've seen that Chinese growth has begun to stabilize. It's unlikely to be as robust as it was in years gone by, but where there may be a decline in commodities demanded by China, it's going to be filled. That gap will be filled by global demand as growth picks up around the world and in other countries as well.
Yeah, if I can just add to that. You know, I think the big thing here also remains, you know, if you look at what happened with South Africa's trade accounts for the month of December, we recorded ultimately the biggest trade surplus that we have in something like 20 years. And that's all on the back of a 30% rise in exports year on year. So it's not only driven by lack of demand locally, keeping a lid on imports, but we're starting to see the synchronized global growth story really filtering through into robust demand for things like South Africa's commodities. So while China has been a big demander of our commodities, it seems for the time being that this global synchronized growth picture that we've seen, and which Claire alluded to on the previous slide, is really coming to the fore and helping the South African economy, and should provide some sort of a support base for industrial metals into the short to the medium term, as long as China remains fairly stable and doesn't completely fall off a cliff.
In addition, we've also seen that within China, as they restructure their economy, a lot of their expensive steel plants that they established to generate steel locally will start to close, as those are incredibly unprofitable and very expensive to run, and there will be a gap as that supply comes offline.
Yeah.
So a lot of has been said about global markets and the fact that valuations are beginning to look toppish and pricey. I think, like there is locally, it exists internationally, a fairly significant dispersion between the very expensive markets and the cheaper markets around the globe. So, while there's no question that a market like the US is starting to look incredibly expensive, there are other markets that still offer attractive valuations. The parts of Europe that have still to experience the same kind of strong recovery that the US has seen. And then even within that there's a bifurcation between the various sectors. So a lot of the bond proxies and the stable dividend payers in the US, as well as a lot of the tech stocks, have gotten incredibly toppish and are experiencing high valuations. But there's also a part of the sector, part of the global market that still offers more attractive valuations.
Yeah. If we really look at what this chart is trying to demonstrate, ultimately, global financial markets become a relative game. So you can say that equities are expensive relative to their history, but, market participants are going to be looking at where else can we be deploying capital. And what the risk asset ratio basically measures is what's the total outstanding value of equities in the world relative to the total outstanding value of fixed income securities in the world. So basically, the market cap of equities divided by the total outstanding risk-free assets in the world, or debt. So U.S. Treasuries, Japanese 10-year bonds, German bonds. And, while we see that the market cap of equities has gone up, certainly over the course of the last 12 months quite aggressively, but generally over the course of the last 3 years, relative to the amount of outstanding debts, we still see that ratio a long way away from the dot-com bubble peak or the financial crisis peak. So to say that markets are expensive and are in bubble territory, I think this is just one measure to show that there still is quite a bit of considerable upside to equity markets from this point before we get to that bubble territory that we refer to of prior to the financial crisis or the tech bubble.
Now, bearing in mind there is an incredible amount of debt that has been created in the world post the global financial crisis. So, debt levels are at extreme highs. But despite the slowing down of quantitative easing, and the fact that the US is now moving to quantitative tightening, that is going to take still quite a while to filter through into the system and to really reduce the amount of debt that's being created. And when we dig deeper and we look at the earnings of the underlying companies, what we can see is that despite asset prices going up and getting much more expensive, it has been driven by a recovery in earnings, and earnings growth continues to pick up. It continues to be robust both in the developed market as well as in emerging markets. Is that the price of these companies might be getting higher, but they're also beginning to deliver better quality earnings, and those earnings are still growing.
And I think again, if we just go back to the previous slide, again, you know, if we chat around earnings growth, if we chat around opportunity set once again, you know, while equities might look expensive relative to history, and this is global equities in general. Obviously, there are pockets of the market, as Claire alluded to, which are exceedingly expensive, which you want to be out of. But within global equities, if you talk about you know, positive consumer sentiment, you talk about the synchronized global economic recovery, you're talking about global corporates starting to invest cash on their balance sheets. And that started to ultimately yield results. That's why we're seeing the pickup in earnings growth that we have seen. And ultimately, you know, as long as interest rates are going to go up, I think there's no debate about that moving forward. But as long as interest rates don't go up in an irresponsible manner, you know, and the Federal Reserve doesn't surprise the market with faster than expected interest rate increases, given the data that's being released, you know, the level of earnings growth that we're seeing relative to the yield which is available in the bond markets would seem to suggest that you know, you've got a growing stream of cash flows that is coming from equities, you know, faster than the stream of cash flows which would come from a fixed income instrument, and ultimately that relative gain still remains quite supportive for the equity market globally, when you look at it in composite. Again, obviously pockets you want to avoid, but in composite, you know, that still paints quite a favorable picture for the global equity market.
Within that picture, you know, even though a lot gets lost in rising global growth, when the world is growing, everyone is happier, and the world becomes a very happy place. There still remains elevated geopolitical risk, and the personalities that are at the forefront of that are not going to change overnight. And the reality is that we still have fairly volatile characters who could decide to escalate their petty differences to a full-scale war overnight. So there still remains high levels of geopolitical risk within the world, driven possibly by the fact that we do have volatile characters, and that there is a lot of uncertainty around how they're going to react, and their behavior is a bit unpredictable. So I think, you know, the Fed have done well at managing the market's expectations and not doing anything untoward or anything that they haven't guided the market towards, and it's likely to remain the same as they begin raising rates. They'll guide towards the raising of those rates, and bar any surprise in or spikes in inflation, it's likely to be a fairly calm and unmeasured trajectory upwards. But unfortunately, the same can't be said for the, you know, some of the leaders in the world, and their ability to come out of left field with comments that raise the hackles of other leaders elsewhere in the world. So there is still a lot of political risk that remains in the world.
I think why we believe this really remains a major risk is that ultimately the way political risk manifests itself is by dampening sentiment, both investor sentiment, business sentiment, consumer sentiment. And what that ultimately then means is that, companies start spending less, companies start investing less, and that's where the earnings growth dries up. And when the earnings growth dries up, all of a sudden that historically high multiple we talk about that the US equity market is trading on, or in fact that global equity markets are trading on, or the big re-rating that we've seen from emerging markets and the big re-rating we've seen from Europe, those PE multiples become a whole lot more relevant when you're talking about subdued growth moving forward because of a lack of investment. So certainly one of the big caveats that we're keeping an eye out for, and one of the things we will be watching closely this year is what's global investment doing. And if global investment starts slowing down, I think then the historically stretched multiples start to become more of a concern than what they currently are.
Which brings us on to what we've just seen. So world leaders met in Davos to talk about the state of the economy at the World Economic Forum, and we saw quite a strong positive message coming out of Davos. Everybody seemed to be more exuberant about economic growth and the fact that global growth estimates continue to be revised upward. America first does not mean America alone. So, Donald Trump delivered the closing keynote address at the forum, and his, I guess, tagline was that, when America is prosperous, it's good for the whole world, which does highlight, his view of the globe and global growth as, he putting America first, and the fact that America is potentially declining as a world economic power needs to be addressed, and having a very one-sided view about how the US fits into the world, and that it's only what's beneficial to the world that's beneficial to what's beneficial to America is beneficial to the rest of the world is very short-sighted. Closing borders and reneging on trade agreements is going to reach a point where America begins to isolate itself from the rest of the globe, and potentially suffers because of that. So that's also an element that adds to uncertainty around the global politics. How America deals with its borders, with immigration, and global trade is going to impact the rate at which the globe continues to grow. So while everybody was a lot more upbeat, and the feeling was a lot more lighthearted compared to the previous year, there still definitely are underlying tensions. The European Union and the UK and its exit from that union is still also very much at the forefront of everybody's minds. And there are also underlying tensions between Europe and the US, particularly with regards to the valuation of their respected currencies.
Yeah, I think And one of the big takeaways as well, it feeds back into the loop we mentioned about political risk and geopolitical risk, and what impact that's likely to have on the global equity markets. We saw a lot of talk about trade wars at Davos. We saw the EU commissioner, slamming Steve Mnuchin and Donald Trump for talking down the dollar. And essentially declaring a trade war with Europe, because obviously a depreciated currency makes exports more competitive and makes imports more expensive. And we're still seeing, I think, while we are seeing a synchronized global economic recovery, we really are also still in it remains a very fragile recovery. So the recovery is robust in terms of the numbers which are coming out, but the fragility remains, and that's and the reason the fragility remains is because the politics still remains just at a head to potentially derail a global economic recovery. And I think that's one of the big takeaways from Davos. And with regards to South Africa, it's definitely been a lot more positive. So since the election of Cyril Ramaphosa as the head of as the president of the ANC, global business is talking to South Africa once again. We saw Team South Africa that went to Davos came back with an exceptionally positive message from Davos that the world is ready to invest in South Africa. Foreign direct investment wants to come to South Africa. We saw Cyril Ramaphosa meeting with Christine Lagarde at Davos, and Christine Lagarde mentioning that South Africa has a lot of potential if it manages to deal with a number of the corruption issues. And Cyril Ramaphosa, over the last couple of weeks, really trying to tackle a lot of those issues head on. We've seen a reshuffling of the ESCOM board. We're seeing charges going ahead and investigations going ahead into state capture. But ultimately, I think for the time being, all of this remains talk, and for South Africa is leveraging the positive global sentiment towards emerging markets because of ongoing improvements in growth, and leveraging increased consumer and business confidence, in the short to medium term. But ultimately, in the long term, delivery becomes critical. And, I think that's going to be the mandate of Cyril Ramaphosa going forward, is that he's got to implement a lot of the structural reforms which are needed to stabilize South Africa. And he seems to be taking the right steps, with ESCOM, being obviously the one structural, systemic risk to the SA economy. And, so I think positive message towards South Africa from the world coming back from Davos, but it's all about delivery at the end of the day. And we need to walk the talk now, ultimately.
Yeah, and that's likely to prove incredibly difficult to do unless the buy-in can be gotten across the board from everyone within the ruling party, and from the private sector as well. But definitely more favorable. It was great to see the president of the ANC get up at Davos and to really feel, as a South African, you were proud of the message that he was delivering, and that things were definitely looking up. So that's the end of our presentation. Sorry for the technical issues. We are willing to take questions from anyone if there are any questions out there.
Okay, well, there seems to be no questions at this point. We'll give it another minute or two before we sign off. But I think if I can just round up with some of our thoughts on the market this year, and what would be beneficial. I think the positive sentiment towards South Africa can hopefully be leveraged into heightened investor confidence and heightened business confidence, which results in greater breadth within our equity markets. And if that greater breadth comes to our equity markets, I think we can continue to see ongoing returns from the equity market, despite the fact that we saw a 20% return last year. We mentioned it at the beginning of the presentation. That was exceptionally concentrated. So we hope that we can see a broader base for returns from equities this year. That will ultimately be very positive. And I think the ongoing, if we can sidestep a lot of the political minefields globally this year, and the politicians behave themselves, we could potentially see another good year from global equities. We question whether we're going to get another 20% year, given the extent of multiple expansion we've seen, but we certainly don't think that's, low double-digit returns from the global equity markets out the question. And we think that could anchor multi-asset class portfolios or, dedicated offshore or local portfolios with a fairly solid base to have ongoing decent returns this year. So that's what we pretty much look forward to.
Yeah, so we will definitely get the tailwinds of rising economic growth globally. It will impact our market. We're coming off an exceptionally low base, so it will be fairly easy to leverage that into positive global growth, which will be good for our markets. We need to continue to monitor the earnings trajectory closely and to make sure that any rising equity prices are not just off the back of improved sentiment, but also off the back of improved earnings. We hope that it will be a better year for our equity managers and their stock picking skills as the breadth in the market opens up, and we see that flows into the market help to re-rate those local shares that have been particularly hard hit. The bond market we continue to watch closely as well as yields move around sentiment with regards to the budget speech. So at this stage, yields probably sitting at a fairly valued point. We wouldn't want to commit too much more to the bond position at the moment, given that there are still fiscal issues that need to be sorted out. And then the offshore allocation has largely been punished by an improving currency and rand strength. So despite good global returns, the translation into rand returns has been hit by an improving currency, which again has also been driven by large flows into the country and improved sentiment.
I think maybe just to wrap up, we'll touch on our position, our ongoing position within global listed property. We still remain fairly optimistic about the prospects for the asset class over the medium term. I think we're still seeing robust earnings growth out of a number of companies in the sector. We've seen a number of them starting to report results as the US has gone through its earnings season, and we're going to see a number of them coming out with results as Europe does the same. But ultimately, we're seeing 6 to 8% earnings growth in composite for the sector, which doesn't sound very attractive, but when your inflation is running at sub 2%, and you've put a lot of developments on hold, so you're ultimately dependent on rental income from your current property portfolio and bringing down vacancies. 6 to 8% is a very good, earnings growth level to be looking at. We're still looking at the global property market trading at sort of a 10% discount to its net asset value. So the 6% earnings growth and the 10% discount to net asset value, coupled with, still a 3% yield spread over equivalent government bonds, that really ticks the valuation box and it ticks the growth box for us which means that we're still quite comfortable having an allocation there. And ultimately, if the world continues to leverage off the synchronized global growth picture, we're likely to see property markets remain or property companies remain in an increasingly favorable position, given the ongoing decline in vacancies, given the above inflation rental escalations, which we're going to be able to see as we see demand pick up. And that ultimately bodes well for earnings growth into the medium term. So, we could see that discount relative to NAV starts closing quite aggressively. And we see returns from the sector remain quite robust, even in an increasing interest rate environment, given that yield spread over the equivalent government bonds.
Great. So that's our story for today. Thank you for joining us. If you would like to get in touch or would like a copy of the presentation, then please let us know, and we'll be happy to send that through to you. And yeah, we hope that you will join us for our next webinar. Thank you very much.
Thank you so much, everybody. Bye-bye.